Welcome to video lesson number 4 of the Forexia Pro education. Thank you for joining us. Today we will be talking about the creation of the trend and how a market maker will create the trend and what he uses to do so. Some of the tools are consolidation and then a swing to the high and the low. This is similar to a TV series, emotionally speaking, where at the end of every TV series or every episode to that series, the beginning and the end of the episode of the series has to end in some sort of suspense to get you to want to watch the next episode of the series, right? And the episode, the TV episode, will likely begin with suspense and then emotionally hit highs, get that climax, and then hit lows, and then come back to baseline to get you wanting to see what happens next. And that's very similar to the creation of a trend and how the dealer moves price in respect to different channels. So here is just a graphical representation of the episode breaks of a TV series. Here's a 6-plot series on a timeline, basically graphed, and this would be the intensity of your emotions, your emotional intensity. And it's very, very similar to the creation of a trend. Now, let's go more in depth on the structure within the trend. So, what we're looking at now is the AUD USD, Australian dollar, versus the US dollar. We can see it was in somewhat of a downtrend here, and then there was that consolidation, and then it spiked to the low and created that W formation that we've talked about many times, or that macro perspective. But within this channel here, within these two trend lines, we have price respecting this channel. So we see the structure here is somewhat of a W. We could have expected this reversal. And then what you see here, what happens next, like we talked about, every day ends and begins in consolidation. These session changeovers you see right here, this blue line represents a new day. And at the start of a new day, the dealer has it's like a new beginning for the dealer. The dealer has his range is now renewed. So the dealer cannot move the market as much as he wants to. In other words, the dealer has his limits. He cannot just throw the market in 500 pip swings every day. That would be obvious that something is going wrong, something is happening. So what they do is every day they reset their amount of pips that they're allowed to move. So we'll get more in depth on how this range, how much range is occurring on each pair, how much the dealer can move per day and per week for each pair in the coming lesson on the daily range. But for right now, let's focus on seeing the consolidation in each session changeover here. We can see there's obvious consolidation ranges and zones, but most importantly, what's happening is the dealer will jam up liquidity in here, right? Retail traders had a very, very long time to buy or sell in this area. The dealer created a imbalance in either buyers or sellers, and then he moved the market upwards in the direction that he wanted to go, in his intended direction, to then meet this channel of resistance here. Support, resistance, whatever you'd like to call it. The dealer met his boundaries and he realized, okay, I have to stop here and I have to start to consolidate and think about reversing for New York session to end the day off in consolidation, to begin the next day, and then swing the high and the low once again. So the dealer, let me find some blank space here. The dealer will start in consolidation, then hit the high and the low, and then end the day in consolidation once again. The dealer then hits either the low or the high once again. Usually it is the high if you will continue the trend, and this keeps going, this movement of hitting the highs and the lows and consolidating, and at the same time he's moving in one general direction, either up or he's moving downwards. And that's how these trends are created. They use session changeover to trap liquidity and then hit the highs and the lows to hit the stop losses, end the day in consolidation once again, and then do the same thing over. And this cycle goes over and over and over until the trend becomes obvious. Okay? So let's just go over what happened. This was 16 days. 16 days of price moving in this channel we have, in this upward trend. And here is the consolidation. Hit the high, come off of the high, consolidate, hit the low, come off of the low, consolidate, create a new low in line with the trend so that retail traders can graph out their pretty little trend lines. Retrace, end off the day in consolidation, fake out low as if the price was going to break out of here, or as if they wanted to fake out and induce retail traders to sell when it was really a buy. Whipsaw, hit the high, come down, retrace, end the day in consolidation. Tap the low, induce the sell, hit stops, come up, fake out high, and then basically end the day in consolidation. Come up once more, end the day in consolidation. Come up once again, create the peak formation right here. And we can see it's a peak formation because it looks a lot like a head and shoulders pattern. We can see that left shoulder, head, and the right shoulder right there. There is that trap move that the dealer created where he induced buyers by spiking the market up in one candle. He then trapped buyers in this area The dealer then comes out of that area, ends the day in consolidation. Then breaks out to the low, retests this range here, this channel right here. The dealer retests right here. Why? There's a very, very important reason. Because he has already hit once, twice, and this would be his third time. Maybe the fourth time, but definitely the third time, and it's obvious that retail traders are now beginning to graph out this trend. They see 3 hits through this trend line, they'll buy right here. And I'm sure a lot of retail traders did buy right there off of that hit. Then, what happened? The dealer showed the retail trader's profit by coming up, consolidated, then spiked to the high, did not create a higher high. Alright, that's very important. The dealer, since he has trapped liquidity in here, he has trapped buyers in here, the dealer cannot be in that range for an extended period of time because he will lose the liquidity of the buyers that he has trapped in this range. So he spikes up and then comes off of that and consolidates. He will not break this high. He will not create a higher high. And that's what Forex and the creation of trends is all about. The highs and the lows. The creation of higher highs, higher lows, lower highs, lower lows, and so on. What happens here is the dealer spikes out of this consolidation range one more time in one candle, just like you saw right here in this trap. One candle traps as many retail traders and breakout traders as he can, and then makes it look like he will continue that upward trend. But in reality, we know what's going to happen. He creates that M formation. You can see that another big spike up to induce emotions, and then that retrace downwards. Ends the day in consolidation, and then okay, this is very important. Remember, the retail traders may have bought on this third hit to the trend line. They could have gained a nice amount of profit off of this spike to the high. The dealer knows that he has been in this channel for long enough that retail traders are starting to sniff him out or graph these trend lines. They're starting to see that he hit once, a third time, and then he gets right down. He comes down off of the trend line as if he's going to bounce once more. And this, just being in this range, in here, right next to this trend line, will emotionally induce retail traders to buy because they see some type of resistance. They've charted on their graphs resistance at this level. So the retail trader sees this resistance, and he also sees this trend line being respected. After 8 hours, alright, if the dealer gives you 8 hours to get in a what you think is a good position, it's not a good position. Trust me. If you're bouncing around in and out of profit, +1, +2, +5, -5, and you've been in there for 8 to 10 hours, you're not in a good place. Alright? And this is why. The dealer will trap as much liquidity as he can in this range. How he does it is by using time. The dealer is the master of time in this market. Literally, he controls how price moves, when it moves, and at what time it moves. So, we must obey by these rules. We can see it took 8 hours to resist or break this support and trend line right here. The dealer is not going to give the retail trader profit. We already know it. We already know this is a fact because we know the dealer has not created that higher high. If we saw a higher high be created, then we could expect this trend to continue upwards. But the dealer did not create a higher high. The dealer created a lower high, suggesting that the trend is now continuing in a different direction or reversing. And we can see that on our big M formation here. So, this trend line here and this support is an illusion. We are not going to be phased by that anymore. And this is what I want you guys to see. I want you guys to see and change your perspective on how you've seen trends and how you've been taught to perceive support and resistance in trend lines, because this is BS. The fact that they say that 3 hits to a trend line gives you the confidence to either buy or sell because the trend line or the support and resistance is now stronger. Yeah, that is not true, you guys. You can see it right here. Once the third hit to this trend line has been made, or this channel, and you can see it right here again. 1, 2, 3. The dealer does not hit it any more times because he knows the retail traders have seen this trend. It's obvious that it's an uptrend and it's moving up. So the retail traders are now expecting the move upwards. What does the dealer do? The dealer then consolidates here, like we talked about, breaks out in one bar past and through your support and your trend line. In one bar. Why is that? That is to make you emotionally unstable and move your stop loss. You now see this new, what looks like a new trend forming. You, as a retail trader, you could have said, wow, maybe I'm in the wrong. Maybe I placed my trend line wrong and it was right here. What did the retail trader do at that time? He created his own confirmation bias. He confirmed his own bias because of this invisible line. His stop loss is now placed under this low. What does the dealer do? The dealer consolidates here, giving the retail trader the confidence to build up more positions because it looks like this trend line is now being respected. So the dealer gives the retail trader time to buy here and here and here. And then what does the dealer do once again, once more? He shifts out of that zone in one candle. What does the retail trader do? The retail trader then moves his beloved trend line below that low, thinking and hoping that price will bounce off of this trend line. If he has not been stopped out already, the dealer gave him time to rethink his decisions and either stop himself out, buy, and I'm sure a lot of people did buy there, and then the dealer shifts in 2 bars completely out of that zone here. Completely out of the channel. What does the dealer then do? Upon shifting the zone, the dealer realizes he cannot go down any further. This is his daily range has been met here. So the dealer then reverses and consolidates, trapping as many people, as many retail traders as he can here in this range. Now remember, retail traders are still believing this channel, this uptrend is valid. They still believe it because they see it. They have not seen what we see yet. So, as a retail trader, you may look at this uptrend and see some type of a uptrending channel and buy in this area. The dealer gives you 2.5 to 3 days to buy. What does the dealer then do? Spikes to the low, inducing as many sellers and hitting as many buyers' stop losses as possible. Then the dealer travels up to hit the stop losses of any sellers that were induced in this move. Then the dealer gives profit, shows profit to any buyers that had their stop losses below here or had no stop loss. He shows profit to any buyers in this area that are still, in this area here that are still holding on to this buy, to their buy anywhere in here. The dealer shows them profit, creates that climax. They get ecstatic when they see these big numbers. They see, let's say you bought here, you're at $100 right here. You look at your screen, you've made $100. You've made $1,000. Price comes down, you get emotional. You think about closing your trade. What does the dealer do? The dealer shifts your emotion very fast. Shows you $110, $120, $1,200. He shows you, he breaks that high, giving you new highs in your emotional system in yourself. All right? This chart reflects your emotions. This entire chart, okay? It's all reflecting emotions. Once you understand this, you'll understand exactly how price moves. So, the dealer shows as many people profit. These buyers hits that climax of these buyers once more. What happens then? Shifts in one candle and consolidates for a few hours. Buyers are still holding on because they've graphed support lines, they've graphed plenty of trend lines here that they see. So the buyers are still holding on. They see profit, but it's not quite at that climax. But they still hold on. What happens? The dealer consolidates a bit, then shifts in one zone. In one candle, shifts the zone, and then ends the day in consolidation. And now we can see that new trend forming. Remember, the dealer's job is to make the retail trader as emotional as possible. Once the retail trader is emotional and is feeling the way he feels after getting jammed and stuck and has no idea what's going wrong, he won't see that the trend is now completely shifting on him. So if he has not been stopped out right here, what happens? The dealer shifts the zone up once more, inducing buyers in one big candle, and then in one big candle hits as many buyer stop losses as possible, traps the buyers, micro trap of buyers within this macro trap we have here, and then we have this support right here that the retail traders may be graphing out. What happens? That trap is used to trap liquidity and then shift the zone under that low, and then now completely shift the entire trend. Now, since that lower low was created here was a lower low, here is a lower low, here now is a lower low, here's another lower low. The dealer sees this as a legitimate downtrend. Here is a high, here's a lower high, here's a lower high. The dealer, or excuse me, the retail trader, I'm sorry, I'm not trying to mix my words up. The retail trader graphs his trend lines once more because this is what he's been taught. All right? He sees these lower lows and higher lows being created. He sees this bigger downtrend that may possibly be in effect here. So, what does he do? What does the retail trader do? Well, the dealer knows this. The dealer knows, well, that's 1, 2, 3 hits there. 1, 2, 3 hits to the trend line here. Let's reverse. Let's reverse the trend on them once they've spotted some type of channel, once they've seen what we're doing. So what does the dealer do? The dealer traps as much liquidity as he can down here, gives you as much time as you want to continue selling. Then what happens? In one big candle, there's the big candle again. You guys, this happens over and over and over. These big candles they can be news, they can happen out of nowhere. Just realize that this is an emotional weapon. It's some type of an emotional manipulation that the dealer is using, okay? Because many sellers here were then shifted into negative, and they had no idea what to do because they saw this downtrend. Their instinct upon seeing this is to wait and see what will happen. Some of them instantly closed. Some of the sellers in here instantly closed upon seeing this. Also, upon seeing this, buyers entered the market. This is where the dealer gave to the retail traders that trade breakouts and bought here. The dealer then shifts the zone as if he is respecting this trend line once more. Do not be fooled. He has already hit it 3 times. After the 3rd time, if he has not reversed already, or the 4th time has not reversed already and stays up there in consolidation, do not act like a fool and continue selling. This was the trap in here. This is the trap zone now. Look what happened. The dealer made it look like the trend was going down, and then trapped as many retail traders as he could in sell positions in this area, as much liquidity as he could, and then shifted the market completely against retail sellers. Whew. Wow. These graphs get messy when I talk. I'm sorry if you guys are bothered by this just super messy graph. But I like to visualize things. So, AUDUSD. This is basically the entire movement of AUDUSD right now. I don't have much more to talk about on this graph, so let's go to EURUSD. We can see a nice downtrend. So we've talked about the weekly structure of the market in previous lessons, and in this lesson we'll go over it a bit right now because I can see a very beautiful structure occurring within this channel. Okay, we can see this was Friday because the market closed here. The market closed and then opened with a small gap, and this is now Sunday into Monday right here. What happens Sunday, Monday? Sunday, Monday, we can always expect, or I should say Friday into Monday or Sunday, Monday. We can always expect that consolidation, and then what do we expect? We expect that trap move on Sunday. We can see the dealer broke out of that consolidation range, or really just continued in this consolidation range here in a macro consolidation, and then in one candle broke out of that range, induced retail traders to sell, and that's when he shifted the zone. This is now Monday, New York session, and then the end and the beginning of Tuesday coming into Wednesday, Monday, Tuesday, Wednesday. We can see consolidation once more in this range, and then that shift in the trend. Consolidation once more into Tuesday, then a shift in the trend once again. The dealer does not break the high of the previous day because he is going to create the illusion of a downtrend. So he will create a lower high, trapping liquidity here, then move down, shift the zone downwards, and trap here. Come up, test that zone once again. That is now the third hit to the trend line. 1, 2, 3. The dealer knows he has to now change the direction in which he is going, because the retail traders have now spotted this third hit to the trend line and have graphed out his positioning. What does the retail trader, or what does the dealer do in this case? The dealer, just like always, gives the retail trader as much time to sell as they want. The dealer shows profit to the retail traders. The dealer then comes up, taking all that profit away, hit that trend line once more, giving more confidence to the retail traders in their little trend lines, and then you can see they created this high, a new high of the day, and then the dealer hit the trend line once more to induce as many sells as he could in this area. what happens then? He shows retail traders profit, then instantly comes back up and in one candle shifts the zone, and then the entire thing happens over again. You can see now it is an uptrend. You can see that happening every time. It's because the retail traders use these confirmations and use these tools to graph out what the dealer's next move may be. And sometimes they are right, but many, many, many times the dealer outsmarts them in the long run and takes their money from them. Oof. So this was quite a long lesson. I really enjoyed it. I hope you guys did enjoy it as well. Thank you for joining me. This was video lesson 4. Until the next one, peace out.